$25 trillion. Just take a second and let the sheer gravity of that number really sink in. That is the estimated size and weight of the entire global artificial intelligence market footprint. But what happens when the financial foundation holding up all 25 trillion of those dollars suddenly starts showing deep structural cracks? In today's analysis, we aren't just looking at some passing tech trend. We're dissecting a massive, urgent financial shift that's happening right now.
Okay, let's dive into this. Welcome, everyone. Today, we're taking a really close look at the systemic transformation and market discipline hitting us in July 2026. We're going to break down the complex and, frankly, sometimes pretty intimidating financial dynamics that define this exact moment in time. Because this isn't just a simple market dip, guys. It is a total systemic transformation and, more importantly, a really harsh return to real economic gravity. So here's our roadmap for decoding this dramatic transition from an AI-fueled bubble to a much more grounded market reality. We're starting with the end of easy financing, and then we'll explore the AI market paradox. Next up, we'll see exactly how DeepSeek acted as the financial detonator, followed by a concrete strategy for this new reality. And finally, we'll wrap up by explaining why this is actually a reset, not a total collapse. All right, Section 1, the end of easy financing, marking a clear macroeconomic transition to a completely new reality. July 2026 marks the undeniable, definitive end of the easy money era that basically defined the entire last decade of investing. Now, to truly grasp what this new reality looks like, we've got to understand the core macroeconomic force driving the whole thing. And that force is deleveraging. Now, what is that? It's the painful process of reducing debt, usually provoked by shrinking liquidity and the rapid tightening of credit conditions by leading financial institutions. And what's really interesting about this dynamic is how deleveraging acts as the underlying gravity for this entire current crisis. When money gets expensive, well, the whole system just feels heavier. Institutions pull back, liquidity dries up, and everyone is suddenly forced to pay up their debts or face absolute ruin. We aren't just theorizing that this is happening either. The cooling signals across major global sectors are flashing bright red right now. First off, look at retail pressures. We're seeing massive discounts from giants like Walmart simply because the everyday consumer is buckling under severe inflationary pressure. Second, there's a major energy divergence. We're tracking a structural drop in China's oil demand, which signals a massive slowdown in the global industrial cycle. And third, geopolitical risk. When we examine the US, Israel, and Iran dynamic, we really have to view this objectively as a strict supply chain risk premium. While markets have somewhat adapted to the daily headlines, it remains a highly unpredictable catalyst for sudden global supply shocks. So all of these cooling signals bring us to Section 2, the AI market paradox, or what we can accurately call the $25 trillion Achilles heel. Because while artificial intelligence is absolutely driving incredible leaps in global productivity, its underlying financial foundation is surprisingly and dangerously fragile. You might be wondering, how did that foundation get so fragile in the first place? Well, the main culprit is private credit risk. You see, a massive chunk of this AI boom wasn't actually funded by traditional transparent banking. It was fueled by explosive, completely unregulated private credit. There's a severe lack of central clearing and an almost entirely absent secondary market for these loans. What this creates are these highly illiquid, invisible bombs just sitting there on balance sheets. As long as the market is going up, sure, everyone ignores them. But the absolute second a crash happens, those assets become virtually impossible to sell or trade.
And that's when those invisible bombs trigger a terrifying domino effect. Let's trace the rapid steps of this margin call loop. Step 1, you have massive, highly leveraged debt in the AI sector. Step 2, boom, a sudden price correction hits the tech market. Step 3, this instantly triggers cascading margin calls, meaning brokers demand immediate cash to keep those leveraged bets open. And Step 4, well, this is the great paradox of the whole crisis. Investors are forced into a blind panic sale of perfectly good assets. We're talking things like gold, cash, or stable bonds, just to raise enough capital to cover their bad, speculative bets. The panic bleeds right out of tech and infects literally everything else.
So, what actually pushed that very first domino? Let's turn to Section 3, DeepSeek, the financial detonator. And this brilliantly illustrates how a singular, really impressive technological breakthrough can instantly transform into a devastating global financial shock.
DeepSeek wasn't just some fascinating piece of code optimization. It structurally destroyed the foundational financial math of the entire market. It signaled the end of monopoly rent. Think about it.
For years, the astronomical valuations of major U.S. tech giants were built on one core assumption: total invincibility and endless pricing power. Their financial models basically assumed they could charge whatever they wanted forever. But DeepSeek proved that highly capable, cost-effective alternatives actually exist. It completely shattered that aura of invincibility and immediately invalidated those aggressive, discounted cash flow models that were propping up all those trillion-dollar valuations. The result? Total psychological whiplash across every trading floor. Consider the brutal shift in market mindsets. On the one hand, you had the old mindset, FOMO, the fear of missing out. Investors were buying AI companies at pretty much any ridiculous price just to be in the game. But almost overnight, that violently shifted to the fear of forced liquidation. Investors aren't looking at the infinite potential of AI anymore, they're staring down the barrel of their own debt. They are absolutely panicking over how to service their massive loans using increasingly expensive dollars.
But, as we know, panic is not a strategy. We need a pragmatic approach to actually survive this shift. So let's move into Section 4, Strategy for the New Reality. We're pivoting from wild speculation to a strict, rigorous focus on quality. Because in a deleveraging environment like the one we're in right now, blindly relying on a passive buy-and-hold strategy is, quite literally, a recipe for disaster. Let's move to and see how this builds a precise, highly actionable framework for your own portfolio. We're going to focus on 3 strategic pillars. First up, liquidity and quality. Your action here is to ruthlessly focus on companies with low debt and high cash reserves. The rationale? Well, when deleveraging hits this suddenly, cash liquidity is pretty much your only real defense. Second, physical assets. You want to focus on gold and silver to hedge against currency instability, paying really close attention to the growing divergence between physical assets and paper markets. And third, active management. You absolutely must diversify outside of high-leverage AI. Start seeking out real value in defensive sectors that have proven undeniable real-world productivity. Which brings us right to our final section, a reset, not a collapse. It is definitely time for a crucial reality check to completely dispel the fatalism and doom scrolling that always seems to take over the media during these intense market corrections.
Now, if you've been reading the financial press lately, you have undoubtedly seen the terrifying headlines. Comparisons to the Great Crash of 1929 are absolutely everywhere right now. Prominent analysts like Michael Burry and Harry Dent are drawing these major doomsaying parallels between the AI bubble bursting and historic systemic collapses. And honestly, it is completely natural to see massive trillion-dollar wipeouts on the market and feel a very real, deep sense of fear about the whole system just collapsing.
So the crucial point is understanding exactly why those 1929 headlines are actually largely misleading. Let's look at why this is a structural reset and not a total collapse. First off, today we have fiscal flexibility and decades of central bank crisis experience that just simply didn't exist a century ago. They actually have the modern tools to mitigate a total systemic collapse. Second, what we're experiencing right now is actually a deeply necessary cleansing of speculative excess. There was just way too much cheap debt chasing way too few viable ideas. Third, this marks a really healthy transition to sector maturity for AI. The unhinged hype phase is over, guys, and the actual business phase is beginning. And finally, this guarantees the survival of companies with real, tangible economic value. The weak, over-leveraged players are getting flushed out, leaving only the strong, fundamentally sound companies standing.
The easy money era is definitively over, and a new era of strict market discipline has officially begun. Now, the AI revolution certainly isn't dead, but the reckless way we financed it, that has changed forever. Which leaves us with the single most important question you really need to ask yourself right now. Take a hard look at your own assets. How are you positioning your own portfolio for this structural reset? Think about your leverage, your liquidity, and where your real value actually lies. Thank you so much for joining me for this analysis. Stay focused, stay disciplined, and I'll catch you next time.